First, calm me down. My fears that this is going to get way worse. It's going to be 2008 all over again. What are you seeing?
Yeah, no, look, the FDIC is in charge here. The government stands behind $250,000 of everybody's bank account all across. Very few Americans have more than $250,000 in their bank. One. Two, banks like Silicon Valley Bank and Signature Bank that failed are very different from how Main Street banks work. Look, you mentioned Silicon Valley Bank's about a $200 billion bank before it failed. Usually those banks have about 1,000 branches across America. Silicon Valley Bank had 16. This wasn't a bank for people like you and me. It was a bank for big tech firms, cryptocurrency, stuff like that. Very different type of depositor base, very different type of company. So the financial system is predicated on trust.
A lot of small businesses had their money in those banks, though. I know somebody who runs a hospice who had her money in there.
Look, in Silicon Valley, in that community, yeah. And there were some small businesses, but there are a lot of bailouts that are being led under the guise of small business. Their biggest person was Circle, a cryptocurrency firm. Second biggest, Roku. Maybe a lot of people are watching this show through that streaming platform. I have them in my house. They had Roadblocks. My kids play that game. So they had a lot of big tech firms because this bank had a venture capital arm. And that venture capital arm had relationships, a lot of these tech firms as they blew up. So there are a lot of small tech firms, a lot of biotech. I'm not
talking
denying
more about Signature.
But I'm telling you, this isn't mainstream bank.
Oh, right, but I'm talking about Signature.
Smaller bank, $88 billion. You know,
right, so my concern is why won't this keep happening?
Well, it won't keep happening for a few reasons. Number one, these banks run very different systems than Main Street banks. Number two, the government came in big, and the government bailed out the uninsured depositors. All those businesses you were talking about, the government made them whole at taxpayer expense, and that's, that's something that we ought to reckon with. And number three, the Federal Reserve came in and bailed out a bunch of banks that made bad bets on mortgages and treasuries that have lost value as interest rates rose, as you mentioned earlier. So look, I went through 2007 and 8. Yeah.
Yeah, I don't even want to think about it. I went through it with you. Help me understand something. You said that it's at taxpayer expense. I thought that this was being done through the FDIC, so it was the banks who were paying and not the taxpayers.
So it's 6.5 dozen. Let me explain to you. The FDIC Deposit Insurance Fund has worked this way for almost 100 years. The banks pay into the fund. The fund is part of the government. It's part of the balance sheet. It's considered taxpayer money. When that money gets expended, the FDIC raises it back from banks. But don't kid yourself. Those banks are passing it on to their customers like you and I. So when the money sits at the FDIC, it's considered government money and taxpayer money. Now, it's not going to the shareholders and the debt holders of these banks that failed. They've been wiped out. That's different than what we did in the financial crisis, and that's an improvement. But, you can't have it both ways. It is taxpayer money when the government's taxing the banks and holding on to the money and building and using it to protect our deposits. Viewers need to know their deposits are safe and the banking system writ large is safe. But there may be a few other banks. This may not be the end of the road. There's some other banks that bet big. I think Barney Frank, the congressman who's a member of the board of Signature, talked about the impact of that bank's exposure on cryptocurrency and what happened there. Silvergate, another bank that failed earlier, had gotten caught up in crypto. So, some of these banks made some bad bets. And look, I think that's okay. America has nearly 5,000 banks a year. Chris, don't you think at least some should fail on any given year? I mean,
I don't have any problem
no
with
bank can ever fail.
I don't have any problem with capitalism. The only time we have a problem with capitalism is when it affects the biggest capitalists. Then all of a sudden, you got to have very healthy bankruptcy laws, and you got to have too big to fail, and all this other stuff. So I'm okay with succeeding or failing on your own merits. I just want to know what the underlying concern should be and what we do about it, like this political kerfluffle about how, Trump did this. It was a bipartisan bill. It was GOP-led, but they reduced the threshold amount so that these two banks fit underneath it.
So listen, the threshold you're talking about that got raised from $50 to $250 billion, when they did that, the Federal Reserve said to Congress, don't worry about the number. The number means anything above that has to, but we have the authority to look at any smaller bank we want that is systemically risky, and we will do that. The Federal Reserve regulated Silicon Valley head to toe. It was a member of the San Francisco Fed board, and the San Francisco Fed had all the authority, all those enhanced powers under Dodd-Frank. And you know what they did? They sat on their hands.
Hey, thank you for watching. Please go to newsnationnow.com, newsnationnow.com, and you can find NewsNation on your television provider. And don't forget to click the red subscribe button down below. Then you will get more of NewsNation's fact-driven coverage.